Okay, let's continue with part 2 of chapter 3, discussing how investments are essentially traded in the marketplace. So there are a lot of strategies that we can think of that certainly have been invented over time. There are what are referred to as algorithmic trading programs. These are basically computerized programs. There's some high frequency trading types of programs that are based on a very short order execution time. Maybe you've heard in the news a little bit about things called dark pools. This is where we have the idea here is preserving anonymity when you're talking about some block trading. So maybe if you want to take control of a company, you don't want anybody to know who you are, maybe you can engage in dark pools to take over a company or to buy some large blocks without anybody knowing you're doing that. With respect to bonds, most bonds are traded over the counter. Quite frankly, individuals in general don't buy a lot of specific bonds themselves. They concentrate usually on bond mutual funds, but certainly bonds are a marketplace, and there are strategies for investing in bonds themselves. With respect to the globalization of the stock market, I'm sure you're well aware of we live in a very small world now. So lots of exchanges have merged. They've come together. So we have fewer exchanges than we used to. But there are lots of opportunities to trade different kinds of securities in different contexts, different formats. So ultimately, as you gain experience as an investor, you can decide where you want to trade. We had talked a little bit earlier about commissions and how people get paid. So let's talk a little bit about that a little more about that. Obviously, you know that there are brokerage. When you invest in securities, you will pay for the right to buy into those securities. So there's a fee paid to the broker. Typically, it's what's referred to as a round-trip commission when you're buying stocks. This is an explicit cost of trading. They tell you exactly what that is. However, there are other expenses that you might have to incur depending on the kind of brokerage house that you are involved with. We'll talk about brokerage houses later, but if you're in a full service kind of a brokerage house, somebody that provides advice, help trading, portfolio analysis, etc., you're going to pay for that a little bit more than what you will in a discount brokerage, where maybe in the simplest form, all you have to do is pay for the account. So you'll pay for the trades as the commission, but you also may have to pay fees for them to maintain your account. So the spread, right? The spread itself is what's the difference between the bid and ask prices. This is a profit line item that goes to the brokerage house. It's what they refer to as an implicit cost. So there are costs associated with making the trade, and then there are the costs of actually paying for the trade itself. That's this spread that we had talked about earlier. So let's think about how you might go through buying stocks. It's a very simple process. You want to buy 100 shares of P&G. You call your broker, or you go online to your brokerage account and you purchase 100 shares of P&G. Now, if you purchase 100 shares of P&G, obviously, you know, as we've just talked about, there are expenses associated with that. So there are things that you're going to have to do in order to obtain those particular shares. So if we think about P&G, right? The P&G stock itself, on the day that I'm making this transaction, it costs $79 a share. So right now, the bid price is $78.91 and the ask price is $78.93. So that's the bid ask. If you see, the spread there is rather low. It's only a penny, right? But that is the difference between the bid and the ask. So what you might ask yourself is, well, wait a minute. I'm going to need, at $79 a share, I'm at least going to need $7,900 to buy this stock. In addition to that, I'm going to have to pay the brokerage fee for the stock. So let's add another, let's just say it's $10, right? So $10 a trade. So you need $7,910 to make this trade. That's if you actually pay for the shares. Now there is a mechanism in place that allows you to borrow some of the money from for this trade. So you're going to borrow it from the broker. You're going to contribute a part. You're going to have an equity position, and then the broker is going to have their creditor position. So the margin refers to the amount or the percentage that you've contributed as an investor. Again, this is your equity portion or your ownership. When the stock price rises, obviously, you make money on the purchase of this stock. The initial margin is typically set by the Fed. They say that at the very least, or at the very most, I guess, at the very most, you have to have a 50% ownership in the stock when you buy it. What that means is you're allowed to borrow, at most, 50% of the money for the stock. Now, the brokerage firm is also going to have a margin. They refer to their margin as the maintenance margin. This is the minimum amount of ownership you can have after you make the purchase. So you're allowed to borrow 50% of the stock when you buy it, which means you own 50%, but maybe the margin could go down as low as 30% in the maintenance margin. So what this means is if the stock price starts to fall, if it falls too far, then you will now have less ownership in the asset than what the creditor might have. So then there might be something called a margin call. And we'll do a couple of exercises here to see how this works. So again, we have a share price of $100. There's a 60% initial margin and a 40% maintenance margin. You're going to buy 100 shares. So you're going to have $10,000 in stock. You're going to borrow $4,000, that's your margin here. And you're going to have an equity position of 60% or $6,000. So if you bought this stock, right? Again, what if they changed the margin to a 70% margin with a 40% maintenance? I've held this stock for a year and a half. It's given me $600 in dividends, and I had to pay $375 on the loan. So what kind of returns am I earning on this investment over time? So let's look at the first example here. This comes from what's referred to as the Return on Invested Capital worksheet. You put here the original purchase price, $10,000. The initial margin, you're told it's a 70% margin. So that means if you look to the right here, the initial equity position, you own 70% of the stock. You've borrowed 30%. If the stock goes to $15,000, what have you earned on your investment? Well, let's look at what happens. The maintenance margin that they set is 40%, which means the balance at which the margin is going to trigger is $6,000. And of course, 15,000 is above 6,000, so you don't have to worry about that. We've added the other information in here as well. Here's the interest that you paid, the dividends that we received. There's the margin that I just referred to. And we have this as being a 1.5-year holding period. So to the right here, we start to calculate some returns. The return on invested capital is just the actual gross return. So in this case, this investment would have earned 74.6%. Now we had this for 1.5 years, so we need to think about annualizing that. And there's two ways to do that. There is an approximation formula, and there's also a time value calculation. The time value calculation obviously will be the most popular one, of course. So in this case, it says what? The return on invested capital that's annualized is 45.02%. Now, if you hadn't made the margin, if you hadn't borrowed this $3,000, you would have earned 52.25%. Again, different from the 74% because it was annualized. The current margin, your current equity position, is 80%. The last line item on here is something called the amount required for a margin call. If this number is negative, it means you do not need to make a margin call. You don't make a call until that turns positive. So let's look at another example. What if the value went to $8,000? Notice the difference. You now have returns. It went from 10,000 to 8,000, so now we've lost money, right? So we have an annualized loss of 17.7%. Without the margin, we would have lost 17.75. Of course, since we borrowed, it's magnified a little bit. Our current margin, 62%. Remember, 40% is the magic number. And right now we have what? We still don't have a margin call. So if you click this one more time at $4,000, now the current margin is 25%, which is less than the 40. So now we would be required to invest $600 into our account to bring this account back up to the correct margin. Now, if we didn't have the $600, the brokerage firm would liquidate some of our market value, roughly $600 worth, in order to maintain the market call for this particular fund. So a question that we might ask is, how far can the stock price fall before there's a maintenance margin? So we started originally with this stock that $100 was the price. Right? So $100 times P minus the $4,000. Again, we have a maintenance margin of 30%. What does the price have to be for that 30% to be matched? So again, if we solve for P in this formula, we're going to find that if the stock fell from 100 to $57.14, then we would be at the 30% margin, and anything less than that, $57.13, would require a margin call. So the idea of margin trading allows us to buy more stocks for an individual investment. However, it has a downside as well as an upside. Again, since we can buy more, we can earn more in gross, but that also means in returns we can earn a little bit more because we're leveraging our account. Leveraging meaning we're magnifying the returns that are possible. The downside to this is, of course, we have to pay back interest, but in addition to that, we also have to worry a little bit about about the margin call, about the stock dropping too far. And of course, as it's going down, because we're magnifying returns, the negative returns are also more than what the returns would have been without the margin. So there's magnification of leverage, right? There's more gross value that can be gained because we can buy more stocks. So there's opportunities for increasing our wealth by borrowing against our accounts. Now what we'll find is you can borrow against stocks and bonds. You can borrow or have a maintenance account or a margin account with options and futures. However, there are no margin accounts on mutual funds. So we'll have to pay full price when we're buying those shares. Now there is another strategy we might want to think about, which is there a way to make money if you're pretty sure the stock price is going to fall? So the concept of a short sale is the idea that when the stock price goes down, I have an opportunity to make money. So how does this work? Essentially, if you think a stock is going to decline in price, you don't own the stock, but you'd like to take advantage of this prediction, you're going to borrow the stock from the dealer. You're then going to sell the stock. You're going to take those proceeds and you're going to deposit those and the margin in an account for a short sale. In the end, if the stock price actually does fall, eventually you have to give the stock back to the broker. So when you close out the position, you're going to buy the stock and return the stock to the person that you borrowed it from. So when the stock falls, you're going to make money. Now on the downside, is you also have to be worried about the stock price rising. If you're wrong, as long as the stock price is rising, you're going to continue to lose money. So what does a short sale look like? Again, we have a margin account, 50%, a maintenance account of 30%, initial price is 100. Again, we know that the sales proceeds in this are $100,000 for this stock. The margin and equity account is going to be $50,000. That's that 50%. We're going to own 1,000 shares of this stock. So what does our balance sheet look like? Again, we have $100,000 in sale proceeds. We also have to have that $50,000 in initial margin. So we're going to have $80,000 in equity and $70,000 in shares. So our profit, if the stock price falls to $70, the profit that we're going to get is the $80,000 that we had in the equity minus the $50,000 in the initial margin, which is $30,000. So that's the decline in share price multiplied by the number of shares that we sold. That's the profit that we're going to earn. So in this case, again, if we go from this 100 shares, right, there's $100 per share. If it drops to 70, that's $30 per share. That $30 per share times the 1,000 shares, we're going to make $30,000. So how much can this stock rise, move in the wrong direction, again, before a margin call? Again, you take $150,000 in this example, which is the margin plus the sales proceeds. From that, you subtract the 1,000 shares times the price. You divide that difference by 1,000 by the price and solve for P so that the equation equals 30%. In this case, if the stock goes from $100 to $115.38, then there's going to be a margin call on this transaction. So the last couple of slides, we want to talk just briefly about some regulations. Not in any real great detail, but we do want to address some issues with trading shares. Number one, there's something called the Securities Act of 1933. The Securities Act of 1933 has coverage of, or it regulates the actions in the primary market. So when securities are being sold for the very first time by companies or mutual funds, etc., they have to follow the rules and guidelines of the Securities Act of 1933. The Securities Exchange Act of 34 covers the secondary market transactions. So the rules of the brokerage are in play. The rules of the exchanges are set out in this exchange or in this legislation. The Securities Investor Protection Act of 1970 created something called SIPC, which is the Security Insurance Protection Corporation. This is equivalent to the FDIC. So some of your shares are protected, some of your wealth is protected if a brokerage goes belly up. There is self-regulation. The financial industry regulates itself through what's referred to as FINRA. FINRA is the Financial Industry Regulation Authority. They set the rules. CFA Institute has standards that they have created that dictate how financial managers are supposed to act with respect to ethics and transactions, etc. Everybody is probably familiar with the Sarbanes-Oxley Act. For our purposes here, the important part of this act is it requires the board of directors to have at least a few independent directors. It also requires companies to personally certify their statements. What we're concerned about is a financial statement that is not transparent, that doesn't give all of the information that we need. If we find out that there is some illegal or fraudulent action that takes place after the statement has been audited and signed, then the CEOs and the CFOs are criminally liable for any actions. So it's a different step than what we had in the past. The last thing to talk about is insider trading, right? Officers, directors, major stockholders, they have to report all of their transactions in a firm's stock. And there's rules that determine whether you're an insider or not. Quite frankly, they left out an entire other part. Anybody that's married to those people are also considered insiders. So insiders do use their information, right? They would be silly not to somehow find a way to take advantage of information that they have. If inside buyers are more than inside sellers, typically the stock does well. So in a situation, if there's more buyers than sellers, the stock price will go up. And if we can determine of the insiders how many people are selling off versus how many people are buying, that could give us an indication of where we think the stock will go in the future. So that's all for how securities are traded.